So thank you very much for being available.
Stages
Sorry.
in building a business. First is we can't hear you.
Yes, I think we are going to be live. So just hold for a second. Yes, I think we are going to be live. So just hold.
So there will be a lag, I believe.
Yes, I think we are going to be live.
You're on mute.
Hello, everyone. Welcome to our first webinar. We will give a couple of minutes before we start. Hello, everyone. Welcome to our... I hear my voice, so just making sure it's all good.
Yes.
Okay. So I think you just voice, so just making sure. Testing one more time so that I don't hear my voice. Sorry about this, guys. Okay, cool. So thank you all for joining. We will start in a minute. So please chime in your questions in the comments on the YouTube so that we can answer those questions. For the first half an hour, Aarjav and Priyal will be giving an overview on today's topic, and then we will open the platform for the questions. So today I'm really excited to have Mr. Aarjav and Ms. Priyal on our platform to talk about this important topic where a lot of people have questions, especially related to some of the reporting regulation requirements, which is based on the taxation status of your particular situation, and also on the remittance, some of the conditions when you can remit, how much, any of the questions related to that. So thank you very much for being with us and sharing the wealth of knowledge that you have. And just as a quick plug-in, DAA, Dinesh Aarjav and Associates, have been helping NRIs. They have helped almost close to 10,000 NRIs with their tax planning, tax filing, and people who are planning to move back from abroad to India, as well as people who are going to abroad, and much more. A lot of our community members have utilized their services and have given a lot of positive feedback. So really very professional, very knowledgeable, and this is something that they have been doing. And they have offices across multiple places: India, USA, UK, Canada, and so on. With that, welcome, Mr. Aarjav and Priyal, and looking forward to your insights on this topic. And we will open up with the Q&A after you go through these slides.
All right. Thank you so much, Avinash, for this amazing introduction. Good evening, everyone, or good morning, whatever the case may be, since we are right now in Indian time zone. So it's a good evening for everyone. So it gives me immense pleasure to address such numerous NRIs who are joining us here. And, Avinash gave a good background about ourselves. So we are a 25-year-old firm, and we have been focusing on NRI taxation for more than 8 years now. So my own sister is a British citizen, and when she moved out to UK, there was a lot of problem for us to figure out good tax consultants who could look after Indian tax as well as UK tax. So once we figured out everything for her by herself, so then her friends started asking questions to us, and that is how we carved out this specific, uh, kind of specific uh, area in our firm regarding to NRIs, and we have helped more than 10,000 NRIs, and the services ranges from when a person starts to moving out of India, returning back to India, sale of property in India, taxation and advisory around all these things, and filing of taxes in India, US, Canada, and US. That's the core area that we're serving on to these days. So I'll just hand over the podium to Priyal. Actually, she is my partner in life as well, and she's a proud SRCC graduate, if you guys know about it, and a chartered accountant. So everyone says that behind a successful man is a woman, but in my case, she is right besides me, so that I keep, I am on track always. So handing over it to Priyal now.
Thank you. Thank you, Arjav, and thank you, Avinash, for the warm welcome and the kind introduction. So, yes, we will take it forward from here. So, just to, give you some idea, after today's session, each of you is going to go back with some valuable insights, and you will be able to navigate through the complexities of taxation and reporting in a more confident manner. So, I would like to start today's discussion by talking about determination of your residential status. So, in my language, I call it the elephant in the house. Because for any tax planning, any discussion, anything, your residential status becomes very critical. One might wonder, like, why is it critical? We understand, like, wherever we are living, wherever we have our citizenship, we are the residents. But it is not that simple. Like in India, your residential status totally depends on the number of days you spend here, irrespective of your citizenship. So this is a major confusion when I am interacting with multiple NRIs. And then why is it important? Number one, obviously the taxation depends on it. Secondly, your reportings and your compliances depend on it. So I've understood in my interaction with numerous NRIs, like once I resolve their residential status, give them the roadmap around it, half of the problem is solved right away. Once you know what is your residential status, how is it going to change, when is it going to change, and what impact it is going to bring to your taxes and your reportings, half of the picture looks clearer to you. So that is how much of importance this residential status is. So I'm sure most of you would have made an attempt to determine your residential status, be it at the time of leaving India, be it at the time of planning your return, or maybe while investing in India. But then, if I talk about your experience, it is confusing. You get different answers from different blogs, you get different answers from different calculators, and you end up going to a consultant to help you. So honestly, the original section is very straightforward. It is the provisos which make it complex. So that is where the problem kicks in. So for the simplification purposes, we have created a flow chart for you where you can follow the steps like a yes or a no thing, and you will reach to your residential status. So Arya, can you just move to the flow chart? Right. So this is the flow chart. So if I look at the current situation, I'm assuming most of you are living outside of India right now and are either frequent visitors of India or are planning a return to India. So for you, the second column becomes relevant, that you are living outside of India and are visiting India. So if you meet certain terms and conditions, then for you, it is the 182 day rule which is relevant. So if you are spending more than 182-day rule, then you have to do another test. If you're not spending 182 days in India, you are simply non-resident. So for people who are returning to India, so for the first year, you can do this test of 182 days. From the coming year, you will have to use the test which is given on the right side of the flow chart, which talks about whether you are a resident, an ordinary resident, or you are a resident but not ordinary resident. So I'm sure in conversations on your WhatsApp groups, on your Google, you would have heard about RNOR status and you would want to know more about it, like how to calculate it, am I eligible for that, and what are the benefits of being in RNOR. So all these things we'll try to resolve for you. So obviously calculation of residential status is very specific to your situation because it depends on the number of days you spend here, and it is very critical around it because there are 3 to 4 conditions which needs to be checked. So on a general rule, if I tell you, if you have spent 10 or more years outside of India and you are returning to India, and if you're returning before October, so you will get 2 years of RNOR which start right from the year of your return. And if you are returning after 2nd of October, then you get 3 years of NR plus RNOR. So 2nd of October happens to be your cutoff. If you want to extend your golden tax planning period by 1 year, you should plan your returns after 2nd of October. Otherwise, so most of the scenes are like people plan their return to India based on the schooling of their kids. So I've seen most of the people returning in May to July. That is the most preferred zone. But in that case, I've seen people planning in the way that the mother and the kids leave in May to June or July, and the father leaves after 2nd of October. It has two benefits. Firstly, as per the general scenario, most of the assets lie under the name of the father. So you get more time for planning for the person who has most of the assets and most of the income to their name. So that is one way you can plan if you are planning your return to India. So now let us see, if one has determined the residential status, now let us get into the details, how important it is, how relevant it is. So this table talks about the taxability. So one of the major things is the taxation when a person is planning to return. So if you look at the first row, any income that you earn in India or you receive in India is taxable in India irrespective of your residential status. This is not where we do the planning. And if you look at the last column, if you become ROR, then all sources of income are taxable for you. Like global income is taxable. So it is also pretty straightforward. So where is the most of the planning? It is in the third row, which says income earned, received and controlled outside of India. So till the time your RNOR, it's not taxable in India. So this is the golden period. Till the time your RNOR, you are living in India, but income tax department gives you this window to manage your assets outside of India so that you can decide if you want to retain them or do you want to liquidate. That's a call that you make in those 2 to 3 years, because they are not taxing you on that and they are not even requiring you to report them to the income tax department. So if we look at the boxes that I have made at the bottom, so as per the first block, which is very, very relevant, because you would have seen a lot of articles coming up in newspaper lately, like income tax department is literally going behind the people who file as residents and do not disclose their foreign assets. Recently, they made headlines saying that they will do a penalty of 10 lakhs if you are not doing that. So they highlighted that part by putting out that article out loud. So that is how important this reporting becomes. So once you become ROR, you have to report all of your foreign assets. You have to include all of your foreign income in India. So if you want to avoid doing that, then you have to plan your assets during your ROR phase. So given the calendar year following in US and the financial year in India is different. So you will always have to keep in mind that March happens to be the cutoff, because from April the new financial year starts. So all of your planning have to run from April to March from Indian perspective. And then the fourth point is something that is very, very important. And this is something which is like a concern for most of the people who are returning to India. So a lot of interactions with me go by the name of that I have made so much of money in the US. It is lying in my bank account. And do I have to mandatorily move it to India while being in the US or during RNOR? Or will I be taxed if I move it to India after becoming ROR? So they think that if they become ROR and they're moving any fund to India, it will become taxable. But that is not the case. That money lying in your bank account is your past foreign income, which you earned when you were a non-resident in India. So that is something which India is not going to tax. But it doesn't mean that it is like completely free of taxation. Anything that you make on those funds, once you become ROR, for example, dividends, for example, interest, or if you're selling any of your capital assets and you're making capital gains, then obviously these things India will tax, because these earnings are happening when you become ROR. So what is important is the instance when you earned that thing. So that becomes the premise of evaluating if it is taxable in India or not. So from this table, what we can perceive is there are majorly two sources of income. You earn income in India or you earn income outside of India. And when we look at the banking system in India, it is on the same lines. Arjun, next slide. So whatever you earn in India, it goes to your NRO account, which is called non-resident ordinary account. And the income that you earn outside of India goes into your NRE account, which is called non-resident external account. So both of these accounts are maintained in INR. And for those who want to retain their dollars, there is another account which goes by the name of FCNR, foreign currency non-resident account, which is alternative to NRE if you want to retain your dollars. So if I want to highlight one of the bullets on the right is the first one. As an NRI, you're not allowed to continue holding a resident bank account. This is something which most of the people are making as a non-compliance, because people move out and they really do not know if there is any change that needs to be done to their bank accounts, because that's a FEMA compliance which is very, very important. So this is something that I would recommend to all of our listeners today, that if you are an NRI, so and you have your resident bank accounts in India, so this should be in your to-do in your next visit to India, that you should convert that into an NRO or just close it if you do not need it. So now one must be wondering, if I have my funds in NRO and NRE, is there any option to repatriate this money outside of India? So I would say a yes to it. But then there are certain terms and conditions. For any income that you are earning in India, if it has been earned through sources which are not prohibited by FEMA and you have duly paid the taxes on it, in that case, you can remit that money outside of India. So in simpler language, if you are meeting the FEMA compliances and you're meeting the income tax laws, then you can repatriate this money outside of India. So this flowchart shows you where all you can transfer your balance from the NRO. So all these options are there. So I would want to focus on the first one, to your NRE, because there it has its own tax benefits. And if somebody has a doubt around it, like what are the tax benefits, then it's your clue to look for a new financial advisor. It's a most common tax benefit that anybody should know. Right. But transferring your funds from NRO to outside of India is not that simple. It comes with its own set of restrictions, own set of documentation. Firstly, there is a limit. You can remit only $1 million, which is obviously not an only thing. It's a significant amount that you can transfer. In 1 year, you can transfer up to $1 million. This is one thing. Secondly, there's a documentation required. So there's a form called 15CA, which is like a self-attestation kind of a form, which the assessee can do on their own, and a 15CB, which becomes relevant in some cases. It has to be filed by a CA. So these are the two forms which goes when you are repatriating your money. So it is somewhere dependent on the banks also. Like there are some banks which do not need a 15C CB for transferring your funds from NRO to NRE, versus most of the banks require it. So that is something that you will have to have a word with your banker as well. So now we have another table which shows the same thing for the NRE, but it has some plus points here. Since NRE, as the name suggests, non-resident external account, it is basically the earnings that you have made outside of India. So repatriating this money outside of India is much simpler. There is no restriction on the amount that you can remit. Secondly, there is no documentation required. So you can call it a freely repatriable account. So that is the biggest advantage of doing an NRE transfer. Now, some of you must be wondering that we have talked about NRO, NRE, 1 million of limit, and then we have talked about the 15 CSCB, but till now we have not touched upon the TCS, the 20% of deduction that most people are scared about. So I'll tell you the reason why. Because TCS is something which is relevant only for the residents. So all the audience who are non-residents, this is something which is not even applicable for you. But still, should you be concerned about it or not? So my answer is a yes and a no both. Firstly, a no, because obviously this is not applicable for you. But then a yes, because you have relatives here, you have family here, you have assets here. So there are times when you have to get a transaction done from a resident to yourself. So this is something which is ultimately going to impact you, though indirectly. So if we look at the transfer of funds, so it has a limit. It has a limit of $250K per resident. It is the annual limit. and then it has its own rates depending upon the type of the remittance. So these are the rates which are applicable right now, but with the budget which was announced few days back, there were amendments made which are applicable from the next financial year. They have increased this 7 lakh exemption limit to 10, and then there are some more relaxation when you are remitting money for education. So that is something that will come out and get updated for the next financial year. So this is something that we had on remittances and all, but there are more things to it. Firstly, we expect a new tax bill which has got passed yesterday itself. So that is aimed to bring about more streamlining of sections and more simplification of things. Now that is something we can expect, but then obviously we will have to wait and watch till this goes out in document form, and then once that comes out, we will evaluate that and keep you posted on what's relevant for NRIs in that. So I think that's it from the content point of view from our side. So I would request Avinash to take it forward from here.
Thanks a lot, Priyal, for that presentation and walking through the different steps and some key takeaway messages, right? I think in terms of making sure the right account and also some of the constraints in that, as well as the tax planning that's crucial in the R&R phase. So please chime in your questions in the chat window, and then we will go through those questions one by one so that these can be answered.
So from where can I see the questions?
Okay, so if you go to that YouTube live link, so all these questions are coming in the comment sections there. That's where you'll be able to see these questions, but I can moderate it for you. Yeah.
Right, yeah.
So there is this question from Dilip. So talk about the introduction of the direct tax code and if there are any plan to remove R&R status on that.
So I would say it's too soon to comment on that. But rest assured, even if they do such an amendment, they will give a phase of transition. They cannot make such things applicable immediately. So there will be some breather out there. But then obviously we will have to wait and watch for what we can expect. Yeah.
Just to add on, there are news articles roaming around here. So the bill has already been passed in this parliament session, and they have specifically told there has been no changes in the budget or in the income tax act, so to say. There are, the idea is to simplify taxes, shorten the taxes, and remove litigation. That is the whole idea. As of now, there has been no specific discussion per se in regards to removal or removal of RNOR status or NR status. So no such thing is required. And as Priyal said, even if that happened, that would not happen, overnight or something, because till now, even after getting the new tax regime by the Indian government, the old tax regime is still available.
Yeah.
People can choose out of both actually as
And
of
it
now.
has been
So
years that we have got the
yeah,
new
so there,
regime.
we
Yeah.
are not expecting removal of RNOR status like immediately. And in case it is removed also, there would be something for returning NRIs to India, for
Yeah.
sure.
Some window there, some relaxation
Yeah.
there, definitely.
Got it. So the next question is the long-term capital gains of foreign stock is 20% or 12.5% after DTC implementation. Maybe it's a question about, is it going to change?
Like I think we've already answered that. So
In
with the DTC coming in, there is no changes expected in the rates also. And as of now, as we speak, it's all 12.5% plus cess plus surcharge. There is no 20% taxation on long-term capital gains. Short-term capital gains are different. In long-term capital gains, there are no
I'll tell
changes
you
in the
why this
rates.
confusion is happening. So when the last budget came in and they reduced this amount from 20 to 12.5, the same is not getting reflected on the income tax portal. So that is the whole reason of misguidance. People see on the portal and it is still showing the previous rate. Although there is a Finance Act which shows the new rate, but then obviously it takes time to get the entire portal and everything updated. So that is the whole reason for the lag.
Got it. And the next question is from Raj. Can we keep our US stocks and RSUs back in USA brokerage account, or do we need to sell before returning to India? If we can keep, what are the tax implications?
It was few years back that FEMA had restricted returning NRIs to have foreign assets, but that is no more a restriction. You can hold it for as long as you want to, but there are two things to remember there. It is very important to disclose it. Like there is a proper schedule for foreign asset disclosure. So once you become ROR, you should definitely make it part of your schedule FA. And then whatever, whenever you sell it off and you make capital gains out of it, or if you are getting any dividend from it, you should add it to your Indian income. So if you are acting in a compliant and a way where you are meeting the reporting requirement, then there is no problem in holding on to those stocks and RSUs.
The next question is from Harsh. If someone has to sell capital assets, the stock options, they will be taxed at short or long-term capital gains in US as per current rates. But what happens when the amount has to be transferred to India? I believe it also depends on the status. So, but you can expand on it. Yeah.
Yeah, so definitely that is something that you have to look upon the status also. If you are selling it while being ROR, it is going to be taxed in India as well. But if you sell it before becoming ROR and you are remitting that money after becoming ROR, then that money is not taxable in India. It's your past foreign income. But after becoming ROR, if you have earned any interest on that bank balance, then you will have to add that interest to your Indian income, but nothing more than that. You can freely repatriate that money from your US bank account to your Indian bank account. It is similar to putting your money from one pocket to another, I would say.
Yeah, another question from Siddhartha. If I sell my US stocks after returning to India during RNOR, I understand the capital gains are not taxable in India. Can I route these funds directly to my Indian bank account without triggering tax?
Yeah, you can do that, but you cannot directly receive that. If you are liquidating your stocks and you directly receive that money in your Indian bank account, then you will fall into the category of income received in India. So it will become taxable. So you have to make sure that you receive it in a bank account in US and then you remit that money to India.
And just to add on, do not do it immediately. Like you sold stocks, got money in your US bank account, and immediately transfer it to your Indian bank account. Then definitely it would be mapped in a sense that obviously the stocks were sold during your RNOR phase, and then immediately you transfer that money from US to India. That can be backtracked to take some time, or take the advantage of different financial years in India and US. Like in US, a financial year works from December to January, and India it works from April to March. So might as well, if you sell stocks maybe in February, and then transfer that money in April, so that there is no backtracking also, and there's a change of financial year as well in India.
We recommend to have some gap between the
Yeah,
two transactions so that they can be viewed separately.
Yeah. So the next question is, what does it mean after spending significant number of years outside India? Is there any specific number after which
10.
RNOR is allowed?
No,
very
so
good question.
RNOR is allowed even if you're living for 9 years outside of India, then you get 1 year of RNOR. If you have lived for 10 or more, you get 2 years of RNOR.
Yes. Next question is from Shankara. I have an NRO account already. If I move to India, can I retain the account or I need to open a normal resident account?
So when it comes to bank accounts and your investment account, it is governed by FEMA. It is not governed by Income Tax Act. So FEMA has two rules. It does not recognize RNOR. It has simply either you are a non-resident or you are a resident. And then they have two rules to it. One is on your intention. The day you return to India with the intention of living here for permanent, like for good, then you become resident from that very day. So if you want to open a resident account, you can open it in your day one itself. And there's a second rule which says that you become resident after spending 182 days. So even if you want to retain your NRO account for 6 months, that's okay. But beyond 6 months, that is something which is we count as a non-compliance, because as per FEMA also after 6 months, you become you become a resident and you are not allowed to have an NRO account. So we would recommend within 6 months, you should convert them into a resident bank account.
Got it. It's a question from Harsh. Can you talk about on the 401k funds, if someone wants to leave in the US till maturity, age 59.5, and then transfer to India? So they are residing in US till 59.5, and then they plan to
Let me take this. So there is no plain black and white answer for this. 401k taxability really depends on how things are actually. First and foremost is if it's traditional or Roth, depending on how much the contribution it has. Then in what financial year, as per India and as per US, you're withdrawing it. So there's no plain black and white answer to it. Yes,
It's a
it is
longer
recommended
discussion.
that correct. That takes a lot of discussion and one-to-one understanding of the whole situation. Yeah, but it is recommended that you convert your 401k to traditional before you move back to India.
Traditional
And
IRA.
yeah, and correct. And then once you move back, then you can decide on to withdrawal. But any which way, there will be taxation in India. There is no way you can avoid taxation in India on your 401k withdrawal if you're returning NR.
Yeah. So two, three things that you should consider there. One, obviously take advantage of tranches if you are withdrawing it. And once you return to India, obviously your income levels in US will not be that significant. It will be passive income like your interest, dividend, rent, all that sort of things. So you will be having a lower income level there. So maybe doing it in tranches helps you be in the lower tax bracket. This is one way of dealing with it. But once you decide to retain it till 59 and a half, then estate tax is something that you should keep in mind if you are not a green card or a US citizen holder. So that is something that you should evaluate if you are taking that decision of retaining it till 59 and a half.
Correct.
Yeah. So next question is from Surya. I'm living in USA and sending money to my wife resident account and investing in mutual funds. My wife also NRI. Now worried about how the tax works and 10% TDS when remittance.
So it is a little concern. If your wife is also an NRI, is she also living in the US? Because if she is, then obviously she is triggering PFIC reporting, which goes in the form of 8621, which is kind of a punitive reporting. A form needs to be filed for each and every mutual fund that you own. So that is little complex. And in terms of taxation also, it is little unfair because they tax you even on the unrealized gains. Like whether you sell it off or you do not, they tax you on the unrealized gain, not caring about the fact that you have not received anything from that fund as of now, but they will tax you. So this is something to be taken care of. Secondly, if you are sending a significant amount of money to your wife, then you should, keep a track of the amount that you are sending, because there are some gift tax rules also that you need to abide by. There are some reportings that need to be done in a specific form if you are meeting certain threshold.
We're talking about US in this case, not in India. In India, there is no taxation with regards to
Yeah.
gift, but in US there
In
are.
US, it is on the donor to do the reporting, and since you are sending that money, so you become the donor. In India, whenever there's a gift, the responsibility is on the donee, that they are eligible for the tax impact. The donors are free, so it is different way in US and India.
So the next question is from Shankara. So if I am an OCI holder and if I plan to work in India, what is the EPF contribution percentage? Is it same as an Indian citizen, or are there any restrictions?
So there is some unfair thing that happens for foreign citizens. Firstly, the percentage is same, but then EPF has certain relaxations for Indian citizens. So it has put up some threshold that you can have a conversation with your employer and make him deduct your EPF at the lowest rate. But in case of foreign citizens, that flexibility is not there. That is one thing. Secondly, for a resident like me, like an Indian citizen, I can withdraw my EPF after 2 months of leaving my job. But that is not the case with the foreign citizens. They have to wait till the age of retirement to withdraw that amount. So these are the two disadvantages of being a foreign citizen while being in employment in India. But there have been a lot of litigations around it. There have been, case laws around it, like people are trying to get it at par with Indian citizens. But right now, this is still under discussion and no concrete decision has been taken on that. But definitely, it's unfair for the foreign citizens.
Got it. The next question is, I'm hoping to move from UK this year. Once I sell my property and move funds, will it attract any capital gain tax?
So if we're talking about the Indian property, then definitely we're looking at taxes. There is no way anyone can avoid taxes in India if the property is situated in India. I don't know about if the properties, well, like we're not clear if we're talking about Indian property or the UK property, but I guess that's Indian property only since he's moving out. but there is no way you can avoid taxation in India
There
by
are some
on sale of equity.
exemptions available in Section 54F and E.
Yeah,
These that is something that can be looked upon.
I
yeah, but
believe he
like
might be
capital.
sorry, I believe he might be talking about the property in UK because he is moving from UK to India and he's selling the property in UK and moving that funds to India. That's what.
So any which way that depends on the residential status. If it is done in RNOR status, then we're not looking at taxes. It would be just another asset that you'll be selling when your global income is not taxable. But if you do it in your ROR status, that is definitely taxable, and you'll end up paying taxes twice in UK and India both, and then gradually you can take benefit of tax credit of either of the one jurisdictions.
Okay. The next one is I'm in US right now. It's question about US income tax. I did not report my Indian mutual funds to IRS. Basically, I filed FBAR, but did not do PFIC correctly. How do I fix it without penalty?
So you can try amending your previous returns at times. They go smoothly. Otherwise, like it's a risk that you will have to take because that is something that you have done, which is a non-compliance. So there is no completely a wide solution to it. So one way is to amend your previous returns, but this might attract some eyes. The other way is to start reporting it from this year. So this is the least you can do. At least from this year, the April 15th filing that is due, at least report it in this year.
Okay. So the next question is from Deepak. How to remit our 401k and 457b plan, US investment, rollover into FCNR accounts through a US bank, Chennai, to invest in Gift City, Gandhinagar, India. So I think they're planning to roll over their funds from US to the Gift City.
So that is a very operational kind of a thing which you will have
Correct.
have the word with the gift city service providers, like how do they do it, but it's a normal transfer of fund, like a wire transfer from your US bank account to the relevant bank account that you will be associating with your gift city investment.
Got. So the next question is, if husband and wife move to India across two separate Indian tax years, like you suggested, pre and post October, can they both claim separate R&R years for their respective assets?
Yeah,
Absolutely.
so in
In
India,
India,
there is
there
no
is
married filing jointly. You have to look at each of you as an individual. Your wife can have a different residential status, you will have a different residential status. So all the income computation, all the reporting have to be decided individually. So there are rumors that India might also come up with a married filing jointly thing, but as of now, it is not there. It's at individual level only.
Yeah. Next question, if a US citizen moves to India, would they be under ROR or RNR? I think the question is, would an US citizen qualify for an RNR status?
I just want to clarify this thing that, like to every NRI in India, your citizenships, like citizenship is a different tax, different law, and income tax is a different tax law. So even if you are a US citizen or anyone, the residential status depends totally on the number of days spent in India. So as per income tax, the tax paying capacity, or so to say, like if you're a taxpayer in India or not, depends on the number of days you spent in India, irrespective whichever or whatever passport you are holding. So India does not mix a passport with taxability, unlike US. US, once you're a green card holder or US citizen, you're always a tax resident, but that's not the case in India.
So you can definitely be ROR and RNOR. This is going to work for you similar to a H1B visa guy returning. It is going to be absolutely similar.
Yeah. So the next question is, are RNRE fixed deposits taxable during RNR phase?
Yes. So
Yes.
your NRE and your FCNR deposits are tax-free only till the time you are non-resident. Once you become RNOR, the interest is taxable. So that is why I recommend people, once they enter into RNOR, they should convert their bank accounts either into RFC or into regular resident accounts, because NRE or FCNR lose their attractiveness once you enter into RNOR. RFC is a bank account where you can enjoy your interest tax-free during RNOR phase as well.
Okay. The next question is, a US citizen wants to roll over 401k in Gift City, Gandhinagar. I think we kind of covered that. I think this is a clarification. Yes, gift tax is not there between spouses. Yes, if it's between spouses, then there is no gift tax. That's right.
No, but there is some threshold above which you will have to do a reporting. There's a form which goes. Obviously, there is no tax liability, but there's a reporting that needs to be done if you meet certain threshold.
Yeah. So the next question is from Sonu. What are the reporting rules for UK, ISA, LISA, SIPP, or notional or unrealized gains in these accounts taxable in India?
So these looks like
Firstly, we
we
will
would
have to
need this.
understand the nature of these assets.
Correct.
We will have to see if it is falling under a capital asset, or is it a kind of a retirement account, or is it kind of a pension. We will have to understand the nature, and the taxability depends on the nature itself.
Okay. So the next question is from Yashu. Uh, how will I be taxed in India if I take full distribution from my 401k, Roth and traditional, pay taxes in US and bring that money? How do you transfer a large sum of money, say example 500k to Indian account?
Do you want to take this?
Yeah. So I've already told you, like 401k taxability is a different discussion altogether. That is all situation based. That is one needs to be discussed in depending on the on the amount we're looking at and multiple other factors. Also, Priyal mentioned previously. Also, you can do it in tranches as well. But coming to your question, how to transfer large sum of money in 500k? See, there is no black, white or black ruling on this. It's a gray area. So basically, what happens is whenever there is any movement on funds from US bank account to Indian bank account during your RNR, no one is going to ask you. Although, if you know the transaction value is super high, there is no one stopping the income tax department from ringing a bell for you that we need answers to this question. So let's be very honest. The Indian tax laws are not that easy as well. And over and above that, the tax department always has eye on any money moving from India to US or from US to India, because there are a lot of other acts that follow on, or are wed with income tax act, that is anti money laundering act, and then FEMA is obviously closely related. So all these things do trigger eyes. So there are certain situations that needs to be figured out by yourself. So obviously, if you want to move 500k, you do not do it in one shot. You don't want eyes of income tax department on your bank accounts. Do it in tranches. Why? To attract eyes. Although in terms of taxability, there is no tax during your RNO status. This is very sure. But why take all those risks only? Why to come into eyes? That is the whole point we're trying to make here.
Like, we have seen people receiving a normal notice of inquiry and they lose their peace of mind because they're not used to
Correct.
such things. And for them, anything coming from income tax department is a matter of worry. Even though that's a normal inquiry which can be answered in a very simple way, because that 500k, obviously you have the evidence, you know what the source is. And if somebody asks you to justify it, you can simply do that. You have your salary source, you have your capital gains, you have your stocks, RSU, which were allocated to you in a very compliant manner. So you can definitely do the story behind it and justify the source, and nobody can question that. You have your bank statements, you have your returns that you have filed, you have your pay slips, so all that helps. But then we have seen just receiving a notice of inquiry makes people panic. So that is the whole idea. If you can avoid those things, well and good. Otherwise, even if you receive a notice and you have done everything in a compliant way, there's nothing to worry about. You have good professionals in India to take care of such situations.
Like, we're not trying to scare you, but yeah, do not come into eyes. When obviously you can, if there's an immediate need of money, might as well do it. But in case you just want to move your funds from US to India, do it in tranches, do it in lesser amounts. Why to attract eyes? That is the whole point we're trying to make here.
Okay, the next question is, can I transfer money to my parents' account, and also is there any limit for those transfers?
So where are you living? Are you in the US?
Let's assume that.
Then
Yeah.
obviously there is that gift tax thing. For this year, it's 19,000 per donee, that if you are sending that money within that limit, then there is no reporting to be done. Amount you're sending above that, there is a form that needs to be filed. Obviously no tax liability, but just a reporting. But then it also depends, from Indian perspective, it also depends for what purpose are you giving that money. If you are giving that money for something which you are not allowed to do. Maybe somebody sending that money to buy an agriculture land, which an NRI is not allowed to as per FEMA. So if you are doing that to do something which is restricted, then it might cause a problem. Otherwise, if it is a regular maintenance kind of money that you are remitting, then there is absolutely no problem.
Got it. So the next question is from Surya: selling a land property in India and receiving the money in cash. What is the legal protocol for remitting that money back to abroad?
I cannot answer this. Please, I would not
Yes.
answer. Neither
There's
Priyal
no
or
way
anyone would
that,
not answer this. Yeah,
Yes.
this is not the right platform to ask the question.
and there is no legal way to do that.
Yeah.
Correct.
Can we still keep the funds in dollars after becoming tax resident? Yes, I think it was already answered, and you need to report that when you become an ROR.
Right.
OCI holder from USA having rental income from US, if relocated to India, how the rental income will be taxed in India?
So in India, the rental income is taxed in a very standard way. So whatever the rental income is, they give you a standard deduction of 30%, irrespective of what amount of maintenance or expenses you are incurring on that property. You might be incurring like 5 to 6% of expense, or might be incurring a 40 to 50%. Irrespective of that, they do a standard deduction of 30%, and the net of it, like the remaining 70%, is taxed as per the slabs.
And you can't put any expenses against that income, the remaining income. So if there is a mortgage interest or
No.
maintenance, you can't. So in
No,
India.
that's about it. Yeah. Because that interest is being paid to a foreign institution. The interest payment on a home loan is allowed only if it is getting paid to an Indian institution.
Got it. So the next question is for an US citizen returning to India, can you elaborate on separate tax reporting requirement to each country? So I think we have covered that in the slide. So please refer to that if you have joined, and if you have further questions, you can reach out to Arjo or Priyal. The next question is from Mahesh. Is it possible to transfer mutual funds holdings to your family members, example, mother, to avoid unrealized tax gains in US and other possibility to avoid taxes?
Yeah,
Very
there's
good question.
a way around it. That is something that you will have to work around with your DMAT account provider, but there is a way around it. Yes. But
Got
then
it.
it is not 100% compliant way, because the intention here is very obvious that you want to escape the tax in US. So there might be some inquiry around it, because that is not 100% like a bulletproof kind of a transaction that is happening. But yes, definitely there is a way to do that.
Got it. So I think this is to the previous question. I think it was maybe a just a clarification on that. So I think Aditya, so this person meant to have these dollars in an Indian bank account, like an FCNR.
Yeah.
So is it
After becoming ROR, you can hold those dollars in RFC account. Or you can have some investments in the gift city as well. They also allow foreign currency investments.
Yeah. The next question is from Shankara. If I move to India and continue holding group retirement savings account where I hold in index funds, can I continue holding, and do I need to disclose the gains or losses even if I continue to hold?
Yes, you can continue holding, but then depending on the nature of this account, if it is a retirement account, then there is a special form which has been introduced 2 to 3 years back, which goes by the name of 10EE. Once you become ROR, you can file that form, and then the taxation in India will get aligned to taxation in US. So like in US, the taxation arises at the time of withdrawal. So same case will be in India. You will have to pay taxes at the time of withdrawal only, not every year on the gains, provided you file that form.
Got it. It's a question from Harsh. Is there an ideal scenario list of when to sell what type of assets to reduce tax burden in India, US to India especially, so the return to India can be planned in advance?
So basically, this
Very long
is one of
discussion.
the this is one of the offerings that we do, because we do, when we plan a return to India for any client of ours, then we do a asset crunching, number crunching, everything.
A
So every
customized
at the end of the
solution.
day, correct. At the end of the day, it's the decision of the asset holder what they want to do. But we tell that what these are the stocks you can liquidate, these are the mutual funds you should keep, these are the investments you can have. So we generally, I'll give you a very high level thinking that since you already have a exposure of US stocks by way of 401ks. So might as well keep 401k for a longer time and then start liquidating all the other assets, explore Irish ETFs to avoid estate tax, and then move a major chunk of money to India, take exposure of Indian markets. Indian markets are booming I cannot say right now, but definitely Indian markets have moved from a very good position from last year. This year, obviously, I understand that there has been a very there has been a
Yeah.
so to say, I don't have the correct words to say right now, but definitely there are beautiful options of Gift City, PMS, AIF, and many other instruments. So definitely India is one of the markets that one should explore. Like India is on track to become the third largest economy in the world. So might as well just consider that. But this is obviously part of a package that we do. And this takes a lot of thinking and mutual discussions between the client and ourselves.
And this also has multiple angles, like we have to consider your financial goals also. Some people need funds immediately after returning to India. Some people are not dependent on the funds that they have in the US. So one thing is that flexibility, and then some people want to have that currency exposure, they want to have the geography exposure. So depending upon what your intentions is, we help you plan accordingly.
Got it. So one question from Sajid. While we are in R&R, which is usually about 2 years, and if I hold, the pounds in FCR account, is that money protected, or is it still only 5 lakhs? So they're talking about the bank, insurance, the kind of a thing in India. So yeah, very good question.
I I'll take this. So I'll tell you, obviously there's a risk with all the banks in India. But I would suggest if you have any such doubts, do not keep money with small finance banks as of now, because these finance banks have moved from being an NBS to a small finance bank. Always trust a public sector bank for such large amount. Even the public sector banks have the same threshold, but we do not see any public sector bank going down anytime soon. In case there is such a scenario, and I don't think that would happen ever in my lifetime for sure, and I don't hope that happens. But in case there is any bank which is going down, so the government would jump in and bail out the whole bank itself. SBI, for a matter of fact, is the biggest bank in India. So if you have fears like this, might as well keep accounts with Bank of Baroda, SBI, these public sector banks. So that is your best bet. But obviously, we get your point, but there is no other way out. But public sector banks are the way for you, definitely.
Then obviously there comes in a picture of not keeping all of your eggs in one basket. So maybe
Exactly.
you can have different banks, different models, and different type of investments.
Okay. The next question is NOR kicks in after 182 days. Does this mean to invest in equity as a resident, one has to wait? Otherwise, if one needs to invest as an NRI without those 182 days, KYC would be a challenge.
So for
Um,
FEMA, once you return to India, you are a resident from that day onwards. And for opening a demat account as a resident, I'm hoping that you would be having a PAN, you would be having an Aadhaar, you would be having Indian bank account, you would be having an address in India. So it should not be a task to fulfill the KYC requirement.
Yeah. I think the key difference is a tax law and then the FEMA law, right? I think the
Right.
resident status is based on that, which drives the bank accounts, the investment accounts, and all that stuff. I think
Right, exactly.
I think the next question is how many months or years before moving to India will it be appropriate to take advice on residency, taxation, etc.?
So we
Is there a
so
time
we
generally
frame? Yeah.
So we generally
so
advise like 1 year to 6 months is the right time, because once you come closer to your date of returning, there are so many other things which become very important, and there are so many things that keep you occupied, and there are so many things that you need to do while being in the US. So maybe you want to do a trust. That is something that you would want to do while you are in the US because it's simpler. So we always advise people to start planning at least 1 year, or if it looks too bizarre, then at least 6 months, so that you have sufficient time to plan. And by the time you reach near the date, you are in the state of peace, that your things are sorted. You know what to do before moving. You know what to do after moving, and what are your timelines. So how does your roadmap looks like? So it gives you little peace and secured kind of a position.
Yeah.
just to add on, I have a client that I'm working with. He is planning to move in 2028 and is planning his return with us right now as we speak.
Yeah.
So that is how, And I think better than us, it would be Avinash who would answer this like of question.
Right.
You can tell him from his
He
personal
is on the
experience
other side, yeah.
how correct, what time did he take to plan his return to India? So Avinash is the better person to answer this question.
No, I definitely would add on. I think the sooner the better. I think you kind of touched base more on the taxation as well as residency regulation, right? But from an investment perspective, what do you want to do with your rental property? Like there are some rules, I think, which we have touched about the 401k, like, the investments in the US equity versus Indian equity, that might take a little bit of a longer view. And then, that's something that you need to plan a bit ahead. But everyone's, view is different. But in terms of from a taxation, from a resident planning on that side, I think it's definitely encouraged to do within 1 year.
Yeah.
But in terms of the investment, I think it took a little bit long horizon, like buying a property in abroad, India, there several factors there.
Yeah, so this
So
guy with whom we are working, he's planning to return in 2028. So we are engaged with him, helping him in buying his villa in Pune, getting him an insurance in India, because by the time he will be back in India, his insurance will have a larger coverage. Otherwise, in India, you have a gestation period of almost 2 years. Till the first 2 years, you have a very limited coverage on your insurances. It is from the third year that you get a significant coverage. So he's already started doing all of it so that once he's back to India, he's all set, all ready, everything sorted.
yeah. All right. Last 5 minutes. So as an NRI, do I have the liability to report the income generated through selling the mutual funds or through SWP in India?
Yeah. So if the sale is happening in India, you definitely have to report capital gains because there is no exemption limit on capital gains. Even if you are making 5,000 of capital gains, the 5,000 INR, that is also taxable.
Yeah.
Oh no,
And
but just to
it
add
is,
on, there is an exemption limit of 1.25 lakhs.
yeah. Yeah. And
Yeah,
also
that is there.
it is more, advantageous for you only because as an NRI, your service provider will be doing a TDS, which is generally at a higher rate than
Exactly.
what your actual tax liability is. So by filing the ITR, you can claim that refund. So it is only at your advantage that you can do it.
Yeah.
And in India, there is no way you can escape, kind of selling of these mutual funds. The PAN is always there. There's always a TDS. So there is no way you would be escaping this. You would definitely come back to income tax department that you owe me some money, give me that money back.
Yeah. So I think last couple of questions before we wrap it up. So can OCI card holder have a demat account or a trade and a stock as a regular citizen? So that's a question.
Yeah, so we have two types of accounts for PIS and non-PIS. We have done a good blog also in terms of this specific, demat accounts. Just go through the blog once because there are multiple things that needs to be considered before doing your PIS or non-PIS account. So that's very specific. So you can easily get answers to this question. Like there are multiple situations that needs to be considered. That is the reason I am referring to, asking the person to refer to the blog.
Yeah.
And also, if you are a US citizen, then there are certain restrictions on the mutual funds that you can own. So you should check that list before investing in any mutual fund. Because if you are an OCI and you are a US citizen, you are always a tax resident of US. So there is a restriction on US residents on a lot of mutual fund houses. There is a list of 7 to 8 which permit US tax residents to invest. So you should have a look at it before going ahead with a mutual fund.
Got it. And then I think the last question before we wrap it up. So for the rental income after we become ROR, would I still be taxed with only 30% deduction? Because I thought double tax will avoid India tax on it, assuming the tax will be due on that only if we cross R2I.
So once you become ROR, definitely DTAA is there. You can take the credit for what you have paid in the US, but by the virtue of math, which I have done at multiple points, the tax liability in US tends to be lower than that in India. So you can take the credit for what you have paid in the US, but ultimately you end up paying something additional in India. For example, if you are paying $1,000 in US, in India it might come out to be an $1,800. So an additional 800 you will have to pay in India.
Yeah. So just I think one last clarification and we can wrap up the Q&A. So this is regarding the question that was earlier about the, reporting the income generated from selling the mutual funds and SWP. I think they're talking more from a US tax perspective. Do we have to report that in a US tax when filing the taxes there? Is the question.
So if you are a tax resident of US, then obviously you will have to report your global income. But if you are not a tax resident of US, then you do not have to worry about it. But as a tax resident, these mutual funds go into PFIG reporting. So yes, that is very important to do.
Got it. So yeah, thank you all for joining us today. And thank you very much, Arjo and Priyal, for taking your Saturday night, especially from 9 to 10, and being with us and sharing your insights, experience, and answering all our questions, from the audience. So really appreciate it. And team, thanks a lot for your engagement throughout the webinar. I think we have about 40 people throughout the webinar, which is awesome. And I have shared few links, the WhatsApp group for Dinesh Aarjav's teams. I know where they have an engaged, where they answer some of the questions. I have shared the WhatsApp link for Desi Return, where we have returnees who have, been part of it. We have about 1,000 people there. So please join and network with other people who are planning to return. And then one last link where you can book a call with DAA team about the services, about your specific situation, on how they can help out. So those 3 links are shared. If you have any questions, let us know. And we are planning to have this presentation on the YouTube so that you can refer to it afterwards. Once again, thank you very much for all your active participation, and really appreciate it. And we look forward to doing some of this in the future, depending on how it goes. But I hope you all liked it. Let us know if you want us to do it again in the future, like at least once a quarter, once every 6 months. Do let us know in your comments. So thanks again for all, being with us and, learning and getting your questions answered.
Yeah,
Thank you
thank you.
so much, Avinash.
Really patient
Thank you.
audience and
Yeah.
really interactive. Like we got some really good questions. So quite happy to answer them.
Yeah, really appreciate you taking the time and patiently answering all the questions. I know some of them are very specific, but really appreciate it. That definitely.
Yeah.
Great. Thank you, guys. Thank you so much.
Thank you.
Thanks.
Thank you. Have a good day. Thank you.